All right, let's get straight into it. Picture this. You find a property deal that looks like an absolute slam dunk, right? A guaranteed winner. Now imagine that same deal just completely morphing into a financial nightmare, one that threatens to take you down with it. I know. It sounds a bit dramatic, doesn't it? But believe me, this whole catastrophe, it all boiled down to just one single, devastatingly common mistake. It's what I call the silent killer of property deals. And today, we're going to drag it out into the light so that you never, ever have to make it yourself. Okay, so let's meet our investor. We're going to call him Mark for the sake of this story. Now, Mark was a sharp guy, really ambitious, and he'd found what he thought was the project of a lifetime. So what he'd found was this old, pretty unloved commercial building, but it was in a brilliant commuter town. And here's the golden ticket. It came with permitted development rights. That meant he could convert it into 4 really high-end flats. The numbers, honestly, they were beautiful. The purchase price plus the build costs, way below the projected end value. On paper, this thing was a guaranteed 6-figure profit. A no-brainer. But there's always a catch, isn't there? And this was a big one. The building was just a shell. I'm talking no kitchens, no bathrooms, still commercially zoned. So, your typical high street bank, they wouldn't touch it with a 10-foot pole. He needed to buy it, and crucially, he needed to move fast. The solution, though, it seemed pretty obvious. Enter the bridging loan. Now, the thing about these loans is they are literally purpose-built for this exact scenario. It's short-term finance designed to do exactly what it says on the tin, bridge a gap. It's perfect when you need to fund a quick purchase or when a property needs a ton of work before a normal mortgage is even possible. They're fast, they're flexible, and the lender, they care a lot more about the value of the asset, the bricks and mortar, than they do about your personal income. So Mark, he goes to a specialist lender and, boom, within just a few weeks, the deal is done. He secured a 12-month unregulated bridging loan, he's got the keys in his hand, and the clock is now officially, and I mean very loudly, ticking. Okay, so the loan's in place and Mark's team gets cracking straight away. And you know what? For the first 6 months or so, everything was going perfectly to plan. On the face of it, his exit strategy was just beautifully simple. Finish the 4 flats, sell them on the open market, pay back the loan, and then just walk away with a very handsome profit. Sounds simple, right? Well, as we all know, property is never that simple. It started with just a few small delays. You know the type. The bespoke glazing got pushed back by 3 weeks. Then a key contractor was out with the flu for a couple of weeks. Now, individually, these are just minor issues, right? Annoying, but not a disaster. But they began to stack up. Suddenly, his neat 9-month schedule stretched to 10, then 11. And that comfortable buffer he thought he had, it was just vanishing before his very eyes. So the project finally gets finished. But by then, the market had cooled right off. Those quick, full-price sales he was banking on, they just weren't happening. The offers that were coming in were, well, they were weak. And all the while, that rolled-up interest on his bridging loan was compounding, adding thousands and thousands to his debt every single month. Can you feel that squeeze? His profit was being crushed from both sides. And then the calls from the lender started. Polite at first, of course, but then they got more and more urgent. Suddenly, that 12-month deadline wasn't just some distant date on a calendar anymore. No. It was a freight train, and it was hurtling straight for him. Because if that loan term expired, the lender had every right to repossess the properties and just dump them at auction for a fire sale price. And we're not just talking about wiping out his profit here. Oh, no. This would almost certainly swallow his entire initial investment, too. Everything. So, where did it all go so terribly wrong? How did this happen? What was the one single mistake that pushed this incredible-looking deal to the absolute brink of total collapse? Look, it wasn't the contractor delays, and it wasn't even the slowing market. Those things are just variables. They happen. In any project, you have to expect the unexpected. You've got to plan for that stuff. No, that wasn't the fatal flaw. The number one mistake, the thing that absolutely killed this deal, was relying on a single, fragile exit strategy. Think about it. Mark's entire plan, his profit, his capital, even his reputation, it was all balanced on the head of a pin. Everything depended on one single outcome, selling all 4 of those units quickly and for a top-tier price. And this just illustrates the point so perfectly. He was relying on hope. Oh, I hope the market stays strong. I hope the buyers show up. Let me be really clear. Hope
is not an exit strategy. It's financial suicide. A professional developer would never, ever show up to the game with only one way out.
So the big question is, how do you avoid falling into Mark's trap? Simple. You build a multi-layered, totally bulletproof exit strategy right from day one. So let's break down exactly what that looks like, shall we?
See the pros? They approach a lender with a plan A, a plan B, and you know what? Very often, they have a plan C as well. And that right there is the difference between building a property empire and watching it crumble into dust.
Okay, first up, you've got your plan A. This is your ideal exit. It's your primary goal. So for Mark, that was selling the flats. But a professional's plan A isn't some number they've just plucked from thin air. No, it's backed by rock-solid recent sales data from the local area. And then, and this is key, you stress test it. Ask yourself the hard questions. What if it takes 6 months to sell instead of 2? What happens if I have to knock 5% off the asking price? You model those outcomes so you know for sure what your real profit floor is.
Now, this is maybe the most important part. Plan B, the refinance exit. This is the safety net that Mark never bothered to build. The idea is simple. If the properties don't sell, your plan B is to pivot. You switch from a sell strategy to a hold strategy. You do this by refinancing that expensive bridging loan onto much cheaper, long-term buy-to-let mortgages. But, and this is absolutely critical, you must get an agreement in principle for that refinance before you even take out the bridging loan. Mark frantically tried to do this in month 11, and guess what? He couldn't get it. He was completely and utterly trapped.
And finally, there's Plan C, the hybrid exit. This is your contingency plan for when things get really messy. So, what if you can't sell all 4 and you can't refinance the whole loan? Well, you don't panic. You break the problem into smaller, more manageable pieces. For example, maybe you sell 2 of the flats, use that cash to pay down a huge chunk of the bridging loan, and then you go and refinance the much smaller, much more palatable loan on the remaining 2.
You know, it's also absolutely vital to understand the tool you're using, because when it comes to bridging loans, you're really looking at 2 very different worlds. On one hand, you've got a regulated bridge. This is for your own home or maybe a close family member's. It's overseen by the Financial Conduct Authority, which means more consumer protection, and it's usually capped at 12 months. Now, Mark's loan was unregulated, which is pretty standard for business and investment deals like his. They tend to be more flexible, sometimes with terms stretching up to 2 or even 3 years. But here's the warning. That extra flexibility can be the very rope you hang yourself with if you don't have that disciplined, multi-layered exit strategy locked in from the start. So what's the big takeaway here? It's this. A bridging loan is an incredibly powerful specialist tool. But make no mistake, it is high-stakes finance. The difference between a spectacular success and a catastrophic failure, it isn't the building you buy. It's the strength and the depth of your exit plan. You have to remember this. The profit isn't made when you buy the deal. It's only ever secured when you successfully exit it. Now, if this has been a bit of an eye-opener for you and you'd like a second pair of expert eyes on your own deal, just to make sure your strategy is completely bulletproof, please don't wait for those frantic calls from a lender to start. There's a link in our bio where you can book a call directly with our team. Let's make sure we get it right from the very start. And one last thing, we'd love to hear from you. Drop a comment below and let us know, what is the absolute scariest property finance mistake you've ever seen or heard about? We'll be reading every single one.